Picture the financial market as an open ocean. Most of us are just paddling around on surfboards, but major banks and hedge funds are like high-powered super yachts. When they move, they tear through the water, leaving a turbulent wake behind them. In trading, we call that empty space a liquidity void. It happens when a major player buys or sells a massive amount of an asset in a split second. They move so much volume that they instantly consume every available order, causing the price to leap from one level to another without any normal trading in between. You can see this on a chart as a sudden, long candle that leaves a vertical gap. Look at how the candles on either side don't overlap. The price moved so fast it literally skipped those middle prices, leaving a hole in the chart. That gap represents the physical footprint of a financial giant. By moving so much volume at once, they have temporarily pulled the stability out of the market ecosystem, creating a vacuum that makes the price move much more aggressively than usual. When you're caught in that wake, your natural survival instincts take over. You see the price plunging and your eyes widen. You feel an overwhelming urge to dive in and chase the move before the opportunity disappears. This is the fear of missing out, or FOMO. It's an emotional reflex that tricks you into jumping into a trade long after the move has already happened, often at the exact moment the momentum is about to stop. Once you're in, the market often starts to settle or reverse. As your trade begins to lose money, you hit a second trap, loss aversion. Even though the data says to get out, you hold on, hoping for a turnaround, because the idea of accepting a loss feels physically painful. This happens because of how our brains are wired. On this scale, we naturally feel the pain of a loss much more intensely than the joy of a win. Even a small loss feels twice as heavy as an equivalent gain, making us stay in bad trades far longer than we should. These built-in biases turn a simple market movement into a disaster for your portfolio. Instead of reading the charts, you end up reacting to your own adrenaline, making decisions based on fear rather than what the market is actually doing. The good news is that the market naturally seeks balance. Just like ocean water rushing back in to fill the trench left by a yacht, price tends to move back to fill the empty spaces left by big institutions. Watch the live price action, and you'll see the market drift back into that liquidity void. It returns to that empty zone to execute the orders skipped during the initial surge. On this chart, you can see the price retracing in a steady staircase motion. It's methodically filling that vertical gap. For a trader who stayed calm, this return to normal provides a much safer and more predictable place to enter a trade. Surviving in the long run requires waiting for this rebalancing. You don't try to surf the chaotic wake of the yacht. Wait for the water to calm to move with the actual flow of the market. Professionals handle changing conditions by swapping their tools. A surfer wouldn't use a heavy, slow longboard to ride a massive, fast-moving wave. They pick a board that matches the intensity of the water. In trading, we do this through adaptive position sizing. This means you calculate how much of an asset you're buying based on how volatile the market is at that exact moment. Look at the difference. On the left, when the waves are huge and erratic, you take a much smaller position. On the right, in calm water, you take a larger one. In both cases, the actual dollar amount you risk sees exactly the same. If you use the same trade size regardless of weather, you are exposed to uneven risks. In a volatile liquidity void, a standard trade size can lead to massive, unexpected losses that your account isn't built to handle. By shrinking your trade size when the market gets wild, you keep your risk constant. This mathematically removes the fear. When the dollar amount at risk is always small and manageable, you don't feel the panic of FOMO or the paralysis of loss aversion. Adjusting your size to match the volatility acts as a buffer for your mindset. It ensures that even when the market moves violently, your account and your nerves remain steady. When you combine this technical patience with adaptive sizing, your trading becomes a disciplined process. You're no longer fighting the ocean, you're moving with it with consistent, controlled execution. Professional traders track their success using metrics that measure the quality of their returns. They don't just look at the total profit, they look at how much risk they had to take to get it. They want to see how much they earned for every unit of stress they endured. This graph shows the difference. The red line makes money, but through a roller coaster of terrifying drops. The blue line grows steadily because the trader prioritizes safety. Professional scores reward the blue line for keeping losses shallow, ensuring the account survives turbulent markets. This approach changes your relationship with the market. When you know exactly how much you are risking and why, the constant worry begins to lift. You can sit with your charts without your heart racing, waiting for the right moment with a calm focus. By tracking the footprints of the big players and managing your risk mathematically, you stop being a gambler at the mercy of the waves. You become a professional who navigates the water with confidence and total peace of mind.